welcome to India Tonight. I'm Shabani Garat and joining me is Sumita Karir. In a long-awaited snapshot of America's economy before the government shutdown, the Bureau of Labor Statistics reports the U.S. employers added 119,000 jobs in September, more than double expected 50,000, and a sign of resilience in sectors like healthcare, food services and social assistance.
Absolutely, Shabani. In fact, if we talk about the U.S. economy, the unemployment rate has also ticked up to 4.4%, its highest since 2021, and that amidst growing labor force and job losses in manufacturing and transportation. In fact, revisions also shaved 33,000 jobs from the prior 2 months, and that really paints a softer picture overall for the U.S. economy. Now, as the Fed weighs a potential December rate cut, this data definitely underscores a job market cooling, but not really collapsing. What to really make of data that's coming in as far as the U.S. economy is concerned? To decode that and more, I'm now joined by Mark Chandler. He's the Chief Market Strategist and Market Managing Partner, Bannockburn Capital Markets. And also joining along with Mark is Gaurav Sengupta. She's the Chief Economist at IDFC First Bank. Thank you very much, Mark and Gaurav, for taking the time out and speaking to us here on ET. Now, to you first, Mark. I was just talking about the data. The unemployment has risen in the U.S. economy. And of course, this report has come in after a delay of at least 7 weeks. However, the jobs have also risen beyond expectations. So how do you really reconcile this, data that is really conflicting?
I agree with you. Thank you. The data is conflicting, but here's what I would focus on. First, we have to recognize, of course, that it's old data and that the jobs data in general are seen as lagging indicators. But also, there's volatility month to month. And so I think that it's helpful to take a look at what the last 3 months were. And it looks like it's about 62,000, a 3-month average. And that, while you say it's coming in a little bit better than people expected, it's true in the short run. But that 62,000 average is about a half of what it was a year ago. And so I think that the general idea, the image would be an economy that's slow to hire and slow to fire. The rise in the unemployment rate, though, I think you're right too, that's really the headline. But the reason that it rose looks like it's because the participation rate increased. That is, perhaps in September, that the recently graduated college people come into the labor market. Participation rate might go up on a seasonal factor, driven. But I think that the idea that I would take away from the data is that the market has actually taken the dollar lower and pushed down U.S. interest rates. I think that the market had expected something along these kinds of data, broadly speaking, of little improvement in the labor market. So the odds of a Fed cut next month have actually fallen a little bit. They've risen a little bit from yesterday. At the end of yesterday, they were about 25% chance, and now it's about a 30% chance of a cut. So nothing major, but it just has stopped at that unwinding of those Fed rate cut expectations. They were 100% at the end of last month.
Gaurav, my question to you is stronger than expected U.S. Jobs, but rising unemployment. What's the spillover signal for India?
I think for India, our monetary policy is independent. And that's not just for India. If you see this year, monetary policy has diverged globally, where EMs are diverging from the Fed, even other DMs are. So US is in a sort of a particularly unique set of circumstances because of the tariffs. So the tariffs will have an impact of higher inflation in the US, and also they will have a negative impact on growth. But that, I think, will show up more next year because a large part of the tariff impact has been absorbed by US companies. But they will pass it on. And when they do pass it on to the consumer, you will see an upward pressure on inflation in the US, as well as a slowdown in consumption. For the rest of the world, the tariffs have a reverse impact, where you will see a downward pressure on goods inflation globally, because the supply that is not finding a market in US will have to find new markets. For example, there are reports of China supply increasing in Asia because it's looking for newer markets to reduce the dependence on the US. So there is a disinflationary force that is working on the rest. So you will see that other emerging market central banks, or even other developed market central banks, will be on a sort of a different track. For us, I think RBI we are in a sort of a Goldilocks situation where we've got 0.25 inflation. GDP growth for us for Q2 is tracking at 7.3%. Q1 was 7.8. There are headwinds, but the headwind is mainly tariff. There is a right now a negotiation that is going on between India and the US. If let's say we get a trade deal with the US, then a lot of the
Right.
downside risk to growth gets removed. And
Right.
as our base case is the RBI may choose to remain on pause in December.
Right. So the RBI could choose to remain on pause, Gaura, given the fact that you've also stated that these are some external headwinds that the Indian economy is facing. But overall, the domestic growth story of the Indian market, that remains robust. I'm going to talk to you about, Fed's rate trajectory, Mark. But let me first address the key point about the state of the U.S. economy. Now, we were just talking about September unemployment numbers, which have come in higher than expectations. But that despite Donald Trump's claims about the U.S. economy being robust, data definitely has a different story to tell because the earnings also seem to be flashing warning signs about the U.S. economy. So from your vantage point, from a market standpoint as well, in terms of what investors are looking at, how does the economy, the U.S. economy, seem to you, at least in the near term?
I think that it's just, in the market, we sort of like letters to describe like what kind of action is taking place. And I think that the K-shaped is probably the best to think about what's going on. And that is that whether it's in the stock market or the economy, it seems like it's being driven by a very like narrow piece of the pie. And in the U.S.'s case, it varies, how you exactly want to make the estimate, but it looks like the data centers and the AI has lifted the stock market, but it also looks like it might have contributed to Q3 GDP. These days, with the federal government having closed for so long, the market is putting more weight on other measures. And the Atlanta Fed, one of our regional Federal Reserves, has a GDP tracker that has a pretty good track record itself. And it's looking at something like 4%, maybe a little bit more than 4% growth in Q3. But the real issue is going to be in Q4 when the government shut down and we've had other disruptions. And so I think that broadly speaking, it's sort of like to those who have is given. And so that's sort of the K-shape that while these are going on in the high and aggregate level, household debt stress levels, delinquency rates, default rates have risen. It looks like the money market is being squeezed a little bit. Some of the key interest rates of repos are a little bit higher than people would expect now that we're past month end. And so I think that there's a lot of uncertainty. I think, though, that you're right, too, that the tariffs, while they're a tax on American consumers, hasn't had that derailing effect that many feared. Partly, I think, because many countries haven't retaliated. They have sort of taken the U.S. hit and they, I think, realize, as Americans do, that it's ultimately a tax on U.S. consumers, which weakens demand.
Mark, my question to you is, NVIDIA's Q3 strength has sort of lifted the global sentiment. So does that really cool this entire AI bubble narrative, or does it keep, all these risk assets frothy as we walk into the year end?
Yeah, I think you're right. I think frothy is a good way to express it. That it's one of those things where it's hard for anybody, I think, to pick the top of a bubble. And I think many people still think that these valuations are at such lofty levels that it's very reminiscent of past bubbles. So exactly when it ends, it's hard to say. But I think that these kind of valuations are very stretched. But I think you're right. It helped lifting sentiment. Many people had feared that we were just setting up for a deeper pullback in U.S. stocks, and more people had come around to the idea of the AI bubble. But NVIDIA's earnings and their forward guidance suggest that there still might be some punch left in the bowl.
Right, Mark. In fact, of course, there is definitely a bubble as far as AI is concerned. However, whether companies will stop investing, whether companies will stop pumping in money, well, that remains to be seen. But for the moment, let me also get in Gaura here. Gaura, we were talking about the Indian economy, and of course, you did mention about the negotiations that are currently going on with the United States as far as a trade deal is concerned. I want to get in your thoughts on what this deal could essentially look like, given the fact that we do have, certain pressures, we do have certain sensitivities, whether it's related to agriculture, dairy, and GM crops, and then of course, we have budged a bit when it comes to not purchasing Russian oil and increasing our energy purchases from the United States. But the sense that you're picking in as far as this trade deal is concerned, and is it imminent given the fact that Vladimir Putin is going to be coming to India on December 5th?
Yes, I think the timing of that visit is also quite interesting. We'll have your RBI policy also during that time. So yes, it is a tricky situation. There's not just economics, it's also political sensitivities that in India will need to balance while negotiating with the US. But in our base case, we do expect a trade deal. If you just look at the data, the kind of negative impact 50% bilateral tariff is having on India. For example, in the month of September, where we have granular commodity-wise breakdown, if you look at US gems and jewelry exports to the US, it's down by 74%. Look at India agriculture exports to the US, I think it's down by 12%. The tariff, the segments of exports to US on which the tariff is effective, they are down by 20-30% in the month of September. So that is just the initial impact of the 50% bilateral tariff. So it does show that we need to get an agreement with the US, and this is not a sustainable fight. And so our base case is that India will come to an agreement with the US. It's beneficial from the US perspective also. They don't want to lock themselves out from a consumption market like India, given our demographics. Our population will only get younger and younger, and the scale of the population in terms of a consumer market, that's not something you would like to lock yourself out of. So it is in the interest of both. It's likely that we should get a deal where the tariff is reduced. India will have to offer some concessions on agriculture, maybe import more, let's say, varieties of corn, etc. Increase its imports from the US for crude. We've already had a separate agreement for buying LPG from the US. It's not part of the bilateral trade negotiations, but it definitely does improve sentiment. So there will be some concession from the Indian side and also from the US side. We do expect the tariff should come down to, let's say, maybe somewhere around 20%. And that will give us, a little bit of a breather on the export front. So base cases, we should definitely get a deal with the US.
Mark, we have just about time for one more question. So I wanted to ask you, how does this entire job print shape the dollar trade over the next few weeks with no major US labor data coming in till mid-December?
Yeah, I think that is really that's the $1 million question. What happens to the dollar? And I'm in the view. So I think about it two different time frames. One is, like you say, in the near to intermediate term, over the next couple of months. And of course, we've got the holiday season approaching and year-end adjustments. And so the dollar could remain firm as the market has taken back that December rate cut. But I think that as we enter next year, slowing Q4 economy, and I think the Federal Reserve, the market's expecting, and when I say the market, I mean the short end, like in the futures market, what they're discounting, the swaps market, they're discounting 3 rate cuts, maybe a little bit more from the Fed next year. And that's important because many other central banks, like the large central banks, the ECB, the Bank of Canada, the Bank of England, these central banks are nearly or almost done cutting interest rates while the Fed has been on hold most of this year. And so I think that policy divergence, the combination of a weaker economy as the tariffs effect kicks in, and we have like I mentioned, the stress at the household level, weaker consumption with the weaker labor market. And so I think the Federal Reserve is going to be cutting rates more than other countries. And in that divergence, I think the dollar is going to fall. And that might help take off pressure off of the rupee as well, where the central bank's been trying to put a floor underneath it.
Right, Mark, we'll have to see how the dollar movement really shapes up, given the fact that, there are some certain concerns with respect to the US economy. Of course, the full impact of tariffs is yet to kick in. But just one final question before we wrap up this discussion. And this is essentially about the data that we were just speaking about, the job spurt that we've seen in the past month that's gone by. But how sustainable is that in the United States, given that there are not just economic fears that are on the anvil, but there are also fears related to AI-related job cuts?
I think this is always a worry, right? Many Americans think that it's somehow foreign markets that are taking American jobs, but I think a closer analysis says it's really technology. But maybe it's a bit early for the AI-related job cuts, as these data centers are hardly even built or hardly even connected yet. But still, to your point, I think that the labor market is slowing, and it's really just the pace of the slowdown. I think that one of the governors, Governor Waller at the Federal Reserve, has suggested that we're at stall speed. And so I think that the weakness of the labor market overshadows the still elevated inflation readings that we're getting from the US, the 3% CPI, for example. It's risen for several months in a row now. But I think the Federal Reserve is going to focus on the deterioration of the labor market, and that's what's going to fuel these rate cuts next year, drive interest rates down, and bring the dollar down with it.
Well, Nvidia has beat Wall Street expectations yet again, posting third quarter revenue of $57 billion and earnings of 1.30 per share, both ahead of estimates. The company also issued a blockbuster forecast projecting $65 billion in Q4 sales, which is far higher than analysts expected. Now, on the back of this, all the major indices are in green. So, we discussed Nvidia very briefly. Gaura, I'm coming back to you. What does this entire Q3 strength of Nvidia reflect? And, can this tech-led optimism offset the macro headwinds for EMs, at least temporarily, according to you?
These are early days, but I have a feeling with AI, you will have a delinking between GDP and labor. So, for example, you will have a situation where the need for employment will go down, but the GDP, because of productivity boost that AI can give you, that per capita GDP goes up. So you'll have a situation, maybe the US is actually reflecting that, where you, as the panelists mentioned, that you have the Atlanta Fed nowcast GDP, though it is for a slightly backward looking, but it's still tracking 4% plus. And the weakness in the job market in the US is been there for, I think, more than a year. We've been hearing the tech sector layoffs happening, even the non-farm payrolls. The kind of revision that happens to the backward data, it shows the labor market was weakening for a while. It just the data didn't show it. Even the current release, you had a downward revision for the previous 2 months. So I wouldn't really read too much into the September print, because most likely once we get October, November prints, which will be released together, again the September print is most likely to be revised downwards. So I think AI might delink per capita GDP from the labor market because of the productivity boost that it gives for the US. For India, it comes at a time where we are actually, given our demographics, the fact that our working age population is going to increase for the next 10 years, we need to find a mechanism of having an intensive job creating growth, which is our key challenge. And top it up, we are not a manufacturing led economy, we are a services led economy. So I think in this day and age, I'm sure AI is going to be disruptive. It's already disrupting the US economy. It'll maybe take some time before it starts disrupting in the Indian economy. But I think the key would be skilling, education, and making the labor force up to a pace where it can get absorbed in the modern sectors. For example, certain sectors in India are really doing very well. For example, the GCC, the services side of the economy is growing much faster than the manufacturing, but you require skilling and education to absorb that labor force. And I would say, every time there's a technological change, everybody seems to see it as a doomsday. But every technological change also creates new types of jobs. So we need to make sure that the working age population, the people that are entering or looking for jobs, have the requisite skills.
All All right, absolutely, Gaura. You very well put the issue of course, skilling the population. While India has a huge domestic dividend, but of course that needs to be skilled as well for us to be able to export that talent abroad globally, and that's essentially what the government of India is also looking at. But for the moment, thank you very much, Mark and Gaura, for taking the time out and speaking to us here on ET Now, ladies and